All right, let's jump right in. Ever wonder what the real secret is to successful investing? What truly separates the winners from, well, everyone else? Today, we're going to crack open the ideas from Morningstar's 5 rules for successful stock investing to figure that out. And it's all about one major shift, thinking less like a trader and more like you actually own the business. So let's do this. And this quote from the book, it pretty much sets the stage for everything. It's a huge wake-up call, right? Stop treating the stock market like it's a giant casino. It's so easy to get caught up in all the noise, the analyst upgrades, the crazy chart patterns. But this is telling us to zoom out and focus on the one thing that actually builds real, long-term wealth. How is the actual business doing? This single idea is the bedrock for everything we're about to get into. So this really boils it down to a fundamental choice, doesn't it? Are you an investor or a speculator? An investor wins or loses based on how well they understand the business itself. But a speculator, their success is all about guessing what other people are going to do. It's about psychology, not fundamentals. And what we're going to do here is give you the mental toolkit you need to firmly plant yourself in that first camp as a real investor. Okay, so here's how we're going to break it all down. First up, we're going to get into the right mindset, the investor's mindset. Then, we'll look at the big mistakes, the traps that so many people fall into. After that, we'll dive into this really cool concept called economic moats. It's kind of the secret sauce for finding amazing companies. And finally, we'll wrap up by talking about maybe the most important thing of all, the difference between price and value. Let's start with part 1, the investor's mindset. Look, before you even glance at a stock chart or a financial report, you've got to get your head in the right place. This is all about the philosophy, the foundation that's going to guide every single decision you make from here on out. The legendary investor Charlie Munger had this incredible phrase, a latticework of mental models. What he meant was, there's no single magic bullet for investing. The best investors have this whole toolkit of different ways of thinking. And the most important tool in that entire kit is the idea that you're not just buying a ticker symbol. You're buying a piece of a business. It's really that simple. You become a part owner. You own a slice of a real company with real products, employees, and customers. And if that business succeeds over the long haul, the value of your piece of it is going to go up too. Honestly, making that mental shift is probably the biggest step you can take toward becoming a successful investor. All right, on to part 2, costly investing mistakes. See, once you start thinking like a business owner, it suddenly becomes way easier to see all the psychological traps that just sabotage most people. Let's walk through a couple of the big ones. First up is the product trap, and oh man, this one is so easy to fall into, especially if you're passionate about new tech or cool gadgets. It's the classic mistake of falling in love with a product and completely forgetting to analyze the business behind it. The Palm Pilot is just the perfect example. I mean, everybody loved this thing. It was a game changer. But as an investment, a total disaster. And why? Because the book points out that the consumer electronics business is just brutal. We're talking razor-thin profit margins and cutthroat competition. So the lesson here is so important. A great product does not automatically mean it's a great business. Okay, the next trap is built on what the book calls the 4 most expensive words on Wall Street. And those words are, this time it's different. You hear that phrase and you should be very careful because it has destroyed mountains of wealth over the years. I mean, just think about the dot-com bubble. Back in 2000, the story was, oh, this time it's different. Analysts were saying that technology had fundamentally changed the rules, that semiconductor stocks wouldn't go through their normal boom and bust cycles anymore. Well, guess what? They were wrong. The bubble popped, and anyone who bought into that hype got absolutely crushed. The lesson? History is your friend. Cycles happen. So, if we're not supposed to chase cool products and we have to be skeptical when people say it's different this time, what should we be looking for? Well, that brings us to part 3, and seriously one of the most powerful ideas in all of investing, the power of moats. This concept, right here, might be the single most important thing you take away from this. An economic moat is exactly what it sounds like. Think of a castle with a big, wide moat of water around it. It's a protective barrier. It's a durable competitive advantage that keeps the competition out and lets the company earn high profits year after year after year. A company with a wide moat isn't just winning today, it's built to win for a long time. So where do these moats come from? Well, one of the strongest kinds is what we call high switching costs. And here's the interesting part, it's not always about money. Think about it. Switching your brand of tomato sauce at the grocery store takes 2 seconds, zero effort. But switching your entire company from Microsoft Office to Google Workspace, the training, the disruption, the lost productivity, that huge hassle is an incredibly powerful economic moat. So the book lays out this really straightforward 4-step checklist to see if a company has a real moat. First, are the profits strong and consistent over time? Second, where are those profits coming from? What's stopping someone else from just copying them? Third, how long do you think this advantage can really last? And fourth, what does the industry look like? Is it a calm little pond with one big fish, or is it a shark-infested tank? And this leads us to our final and maybe most critical section, price versus value. Because here's the thing, you can do all the homework, you can find the most amazing business with a wide, deep moat, but if you pay too much for it, it can still be a terrible investment. You've got to remember what the legendary investor Sir John Templeton said, you want to buy when there's maximum pessimism. Your job isn't just to find great companies, it's to buy them when they're on sale, when they're unpopular or misunderstood or just plain overlooked. Those moments of fear and panic are when a stock's price can fall way below the company's true value, and that is where the real opportunities are. So how do we even begin to figure out if something's a bargain? Well, this example with Motorola shows why some of the common tools we use can be tricky. Look at the popular PE ratio. It was basically useless because the company wasn't making any money. But if you looked at a different metric, the price-to-sales ratio, a clearer picture starts to emerge. By 2002, you can see the stock was way cheaper relative to its sales than it had been in years, which was a big clue that it might be undervalued. But even the price-to-sales ratio has a major flaw. A dollar of sales at one company is not the same as a dollar of sales at another. Think about it. A dollar of sales at a low-margin grocery store is worth way, way less than a dollar of sales at a super high-margin medical device firm. This just shows you can't compare these numbers across different industries. The takeaway is that these metrics are helpful, but you absolutely have to understand the context. And that really brings it all home. It ties everything together into this simple but incredibly powerful mental model. Step 1. Focus on the business, not the squiggly lines on the stock chart. Step 2. Know your own psychology. Know the emotional traps and actively fight against them. Step 3. Become a hunter of companies with wide, durable economic moats. And Step 4. Be patient. Wait for the right price. So, we'll end with this question, just for you. Now that you have this framework, which one are you? Which one are you going to be? Are you an investor whose success is tied to the actual performance of a business? Or are you a speculator, trying to guess the whims of the crowd? Because really, the answer to that question is going to define your entire journey from here. Thanks for joining me.